Welcome to this summary of the Little Book of Common Sense Investing, a book by John C. Bogle, the founder and now retired CEO of the Vanguard Mutual Fund Group, an American investment management company. But before we begin, please subscribe to our channel and like the video. Are you curious about the best investment option? Let us discover the benefits of index funds. Just like the variety of chocolate bars, mutual funds offer numerous options, making it challenging to decide where to invest. To ensure security, consider pooling your investment with others in a diversified, low-risk fund or opt for high-risk, high-reward funds. However, navigating these choices can be daunting, and making poor decisions with your money is the last thing you want. This summary simplifies the decision-making process by advocating for index funds. It highlights the differences between passive and actively managed funds, emphasizes the importance of selecting funds with low fees, and offers strategies to avoid market bubbles. Before we delve into the key highlights from this book, please consider subscribing to our channel and like the video. Now let us continue. Part 1. Actively managed funds are expensive and consequently often underperform the market. Investing in the stock market can be challenging, especially when assessing the attractiveness of individual stocks. Many investors opt for actively managed funds instead of direct stock investments. In these funds, money from multiple investors is pooled and managed by a specialized fund manager who adjusts the portfolio regularly. However, such investments come with significant risks due to high costs. Investors incur brokerage commissions and fund manager fees, eating into potential profits. While some actively managed funds may perform well in the short term, over time, they often yield lower profits compared to the overall stock market. Speculating on stock prices is not a sustainable strategy. While it may seem lucrative to buy undervalued stocks and sell them at higher prices later, in the long run, this strategy cannot outperform the underlying company's earnings, as reflected in the overall market performance. When combined with high fund costs, actively managed funds typically generate less profit than passive index funds that mirror the market's performance. For instance, investing $10,000 in 1980 could result in 70% less profit by 2005 with an active fund compared to an index fund, primarily due to fees. Part 2. Few funds perform well, and there's no guarantee even those few will continue to do so. Despite the allure of actively managed funds, it's crucial to evaluate their performance compared to the overall stock market before investing. Unfortunately, most of these funds fail to deliver significant returns and many even go bankrupt. Investors often pay substantial fees to access the expertise of financial professionals who purportedly understand the stock market intricately. However, the reality is sobering. Only a fraction of mutual funds established in 1970 have consistently outperformed the market and remained in operation. Given this reality, entrusting your money to fund managers may not be wise. Even if a fund has a successful track record, there's no guarantee of future performance. While you might be tempted to invest in funds that have historically outperformed the market, it's essential to recognize that past success doesn't necessarily predict future outcomes. Consider, for instance, the role of the fund manager. If a manager has been instrumental in a fund's success over the past decades, their eventual retirement raises questions about continuity. Moreover, future investment landscapes will undoubtedly differ from those of the past, making it challenging to predict which opportunities will emerge. In essence, the uncertainties surrounding future market conditions and fund management warrant careful consideration before investing in actively managed funds. Part 3. Most people invest in actively managed funds unaware of all the implications. Despite the underperformance of most funds, people continue to invest in them for several reasons. Firstly, investors often underestimate the true costs associated with actively managed funds. While these funds come with high costs, fund managers typically focus on highlighting their high returns without disclosing the actual amount investors will earn after deducting performance and portfolio fees. Shockingly, many of the most successful funds in the late 1990s reported returns higher than what investors actually earned. Secondly, emotions and current market trends often drive investment decisions. Many investors succumb to popular opinion and clever marketing, leading them to make unsound investments. For instance, during the late 1990s, a significant amount of money flowed into high-risk investments as the market boomed and stocks were overvalued. However, when the bubble burst, investors realized the folly of following popular hype. This trend extends to actively managed funds, as investors often follow the crowd in allocating their money to these funds. Given these challenges with actively managed funds, where should investors consider putting their money? Let's explore some sensible alternatives. Part 4. Put the majority of your assets in safe, low-cost index funds. Now that you understand the pitfalls of actively managed funds, don't resort to keeping all your money under the mattress. Instead, consider index funds as your best alternative. Unlike actively managed funds, index funds offer significant cost efficiency. These funds hold diversified portfolios that mirror the financial market or specific market sectors. Rather than speculating on individual stocks, index funds maintain their portfolios indefinitely, avoiding the risks associated with short-term, volatile bets and minimizing operating costs. Index funds, also known as passive funds, track the performance of all stocks included in the index without engaging in active trading. This means you won't incur fees for buying and selling shares, financial consultations, or fund management. Instead, you'll enjoy the benefits of net returns. Another advantage of index funds is their tendency to outperform actively managed funds over the long term. While some may argue that holding shares indefinitely misses out on buying low and selling high opportunities, you've learned that the stock market's fluctuations eventually balance out at the true value of stocks. Consequently, index funds typically outperform actively managed funds by offering returns aligned with the real value of stocks while eliminating active management costs. In the next section, we'll delve into selecting the right index fund for your investment needs. Part 5. Choose the cheapest index fund. Each index fund comes with an expense ratio representing management fees and operating expenses. While these expenses typically amount to less than 1%, they can accumulate over a long-term investment horizon. For example, the Fidelity Spartan Index Fund boasts an annual expense ratio of 0.007%, while the JP Morgan Index Funds ratio is 0.53%. Although both funds have expenses below 1%, over extended investment periods such as a decade, these fractions of a percent can significantly impact returns. Given that index funds track the overall market fluctuations, prioritize selecting the fund with the lowest cost structure. It's important to note that a fund's expense ratio doesn't necessarily correlate with its performance level. Part 6. Be wary of new investing trends. When deciding where to invest your hard-earned money, it's essential to approach the latest investment trends with skepticism. The intense competition among index funds has led to a continuous cycle of new trends. Since their inception in 1975, the market has seen the emergence of 578 index funds, each vying for investors' attention. Established funds strive to attract investors by lowering their costs, while newcomers promise higher rewards through innovative stock-picking methods, often at a higher price. For instance, movements like the New Copernicans diverge from traditional stock selection methods such as weighted market capitalization. Instead, they may base their portfolio compositions on metrics like company profits or dividends paid. However, regardless of a fund's operating claims, accurately identifying over or undervalued stocks remains challenging. Therefore, it's prudent to stick with funds that maintain a conventional portfolio structure. Moreover, since predicting the success of new investment trends is uncertain, prioritizing low costs is crucial. The key message is to avoid actively managed funds as they erode your earnings with high fees, benefiting financial intermediaries more than you. Opt instead for index funds to maximize your returns. Actionable advice. 1. Reevaluate your investment choices. 2. Allocate the bulk of your assets to an index fund for stable, long-term growth. 3. If you desire some speculative investing, limit it to a small portion of your portfolio with actively managed funds, no more than 5%. While it's okay to take calculated risks with a small portion of your funds, prioritize the safety and growth potential of the majority of your investments. And lastly, thank you for watching this video. And please like the video if you enjoyed it. Also, let us know what you rate this book in the comment section down below and what book we should review next.